Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Reminder that the show is designed to build the D.C. Metro's markets by giving you good free advice. If you ever have any questions, concerns, real estate needs, the best number to reach out to is 877-245-2030. That's 877-245-2030. Remember, that's an off-air phone number. But if you're looking to refinance, or you're looking for a purchase mortgage, or you're looking for a good real estate agent to assist you through the process, if I can't help you out, I'd be glad to put you in touch with somebody that can in your local area. Again, those numbers are 877-245-2030, or visit us via the web at realestate360live.com. That's realestate360live.com. So, Louis, you and I were just talking about the durable goods order that came in better for December. I just pulled up, and the mortgage market it's losing ground again today. Mm-hmm. The 10-year note is now at 1.9918, so it's almost up on that 2% number, which we haven't seen in a long time. Friday, that number had jumped to 1.95, so we're heading up significantly quickly right now. So I would venture to say that heading into this Fed meeting, if Bernanke says anything that continues this positive tone, that the market, the bond market, mortgage bond market, will continue to tank. We will continue for the rest of this week. So,
and oil, gas, gold, and silver will drop.
Absolutely. And I mean, so what I'm telling people out there is like, don't play with fire. I mean, there's too many things that the Fed and Bernanke can say that can really sway the market one way or the other. There's more likelihood of interest rates getting worse than getting better. And typically, if most people don't follow interest rates and mortgage-backed securities and the trends, but when you start to follow these things, they tend to head in a certain direction for a while. It's not up. We stagnated there for a long time for the last couple months.
Well,
now,
it's by design. That's exactly how the Fed wants it.
Yeah, I mean,
they try to manipulate interest rates for a period of time to certain levels, and they actually control interest rates.
Well, but it gets to a point though where that manipulation turns against them, where
they can't control it. That's correct.
Right, and
they've kept the lid on the pot for so long with these artificially low interest rates that eventually they have to rise. I think they're going to start to let some of the steam out of the pot.
Yeah, and I mean, I feel like that's what's going on right this second. I'm just,
interest rates should be higher, right, Ryan? If capital wasn't available as a result of the financial crisis, if the Fed didn't put it in there, it'd be very expensive to borrow money, and interest rates would be higher. They purposely flooded the system with money to keep interest rates low, to avoid a depression, which is what we needed.
The interesting part is they're flooding them.
Not the money flowing.
Well, they're flooding the markets with money, right? So the banks have all this money at their disposal to lend, yet the banks don't want to lend because of the interest rates are too low. So what should real interest rates be if there was an artificial manipulation and the actual markets dictated what was going on with the interest rates? I would say that they should be at 6.5%.
Who knows where they'd be, but they'd be higher but for the intervention of the Federal Reserve.
Absolutely, but what would happen is if
interest rates reflect what the market is doing, and we don't know what the market would have done absent Fed intervention. But we know that interest rates would have risen because capital would have been scarce, because people would have been deleveraging, and there wouldn't have been as much money available for entrepreneurs to invest. So therefore, interest rates would be higher.
Yeah, and with higher interest rate, private investors are willing to take on more risk, right? They're less risk averse when they have interest rates that are around the 3% levels.
And that's what the Fed wants. They want reckless people borrowing money and indebting themselves.
Yep, and so is there a scenario where interest rates go higher and lending standards ease up a bit? I would say absolutely.
Absolutely,
because
I agree.
What tends to happen is they tend to go too far. So what makes me a little curious about all this is that the same time that the Fed is basically manipulating interest rates and the interest rates are starting to rise up a little bit, behind the scenes they're working on the qualified residential mortgage, which is what I was discussing earlier, which is the potential for them to come out with a rule that states that there needs to be X amount of down payment into a loan in order for a person to qualify. So what that really means is that right now, like let's say FHA is at 3.5%, but let's say that they determine that a qualified residential mortgage, everybody has to put down a minimum of 10% in order to get a mortgage. Well, this is something that's been debated for a while, and they're trying to get some sort of they're going through numerous committees and consultants and trying to figure out what is the best course of action here. I don't feel like they're going to change too much, because to make somebody come up with a 10% down payment or a 20% down payment for that matter, and think that the housing market would not just be completely crushed.
How many people do that today? I mean, the savings rate is so low. People don't put down 20%, do they?
No, they don't. And not only that, a lot of buyers that are out there right now are institutional buyers. They're not your mom and pop everyday guys. So I think that there's so many things that are actually working against the housing industry, that rising interest rates to me are I guess they could be a good thing in one sense, because I feel like lending standards would start to ease up a bit, but they're a bad thing on the other side because people don't have that much disposable income to begin with. So, I really feel like that the real estate market is going to start to really be pretty stagnant for the next year or so. I mean, people in my area, in the Northern Virginia, D.C. metro area, people are very frustrated right now because we have very low inventory. And part of the reason why I feel like we have low inventory is because 1 in 3 homeowners is upside down on the property that they own, right? So their only way out of that property is to short sale or stay in it and hold on to it and hope that the market comes back enough to where they can get out. And for a lot of people, that has happened. For a lot of people, they've gotten enough equity back in their home to where they're in a break-even situation where they can get out, or they could even make a little bit of money to move on. But on the other side, there's just not, especially in the lower end price range, let's say 400 and under, you're not going to find too much. So you go up into the jumbo market, and yeah, sure, there's a lot more inventory in the jumbo market just because there's not near as many people that have that amount of money to buy homes.
Right.
Like you said earlier, Lewis, I mean, how many people are making over $250,000? Not that many.
And most of them are clustered along the coast.
Absolutely. And I brought up before we went to break, so the Realty Track had done like an updated information on foreclosures and how this is basically the lowest amount of foreclosures that we've had in a while. And basically there's 4 states that almost, 50% of the actual foreclosures are located in now: Ohio, Illinois, Florida, and California. And then the other 50% is spread out amongst the rest of the states in the United States. So it's interesting.
Nevada and Arizona weren't in the top 4 anymore.
Well, what I'm thinking is going on in those states, Lewis, is that, like we've discussed before, where we have a lot of lenders that are bulk selling their notes, right? Bulk selling note purchases, because you have Fannie Mae, Freddie Mac, FHA, they're all doing it now. All the big, conglomerates are selling their notes in bulk and choosing not to foreclose. So those wouldn't necessarily show up as foreclosure statistics. You know what I mean?
Also, because those are lower priced homes, so they were probably, a lot of them have probably, the inventory's been worked off.
Exactly. And for people out there that are still, sitting around, whether you're an investor or you're a first-time home buyer and you're looking to get a great deal on a foreclosure, if there's the few that are out there, especially in the D.C. metro area right now, they're not even priced. I mean, there's a few that need, obviously the rehabs that you can get at a better price, but there's not that many. And if you plan on getting a deal, which you think would be a deal right now, you probably want to look now, because I would say the next year going forward, they're going to dry up even further. It's known that a majority of these huge hedge funds that are out there right now, they've got billions of dollars on the sideline ready to buy up as much real estate as possible, because they know as interest rates rise back, and rent prices continue to increase, it's a solid asset for them to hold. which is going to put more pressure on the first-time home buyer that's out there trying to not only qualify for a loan to buy a home, but now they got to compete against the institutional cash buyers that are out there.
And the foreign cash buyers. And this highlights the irony of all the government intervention and programs designed to make homes affordable for the average person and to increase home ownership. And what ends up happening at the end of the mess that they create, institutional rich people and foreigners end up buying the homes, and all the people that these programs are designed to help to get them into homes are now renting and have probably gone into foreclosure if they used to own a home.
Yeah, I had a fellow that actually had asked me the other day a question about, why would somebody come over here and buy a property that, like, they go to the courthouse steps where they're basically, auctioning off a property once it goes to foreclosure, and somebody pays, typically an investor would want to only pay maybe like 80 cents on the dollar because they'd have to go in and fix it up. They typically don't know what the inside of the property looks like, so they're going to, they have to take some of that risk into consideration when they're buying it, so they try to buy around 80 cents. Well, there's people that are at the steps now that are buying stuff at 90, 95, 96 cents on the dollar. Well, the reason why they do that is because a lot of this is foreign money coming from Asia and other places where currency differential, it's still a good buy for them here. And we're seeing a mass amount of money coming from overseas that's being invested into our real estate markets. So there's not as many, 2-3 years ago, there were great deals for people that were, here in the United States that wanted to buy things at, 75, 80 cents. But now, good luck. You're going to be looking at many investors, foreign money and participation that's buying things at 90, 95 cents, even close to real value for the home. What are they doing with them? The majority of them, they're not flipping them. They're holding them. Long-term rentals. Mm-hmm. They're holding them because it's a good cash flow for them. I know
investors who do the same. Occasionally they'll flip a home if there's an opportunity, but most of them are renovated for purposes of rental.
Yeah, absolutely. And I know one investor in particular, that's all that he does. He's buying up every property he can get his hands on, especially if they're, $150,000 or under. He's buying up all of them and renting every last one of them out. And he's like, these are just all long-term holds for me. I'm going to have cash flow coming in on the rental, and, eventually if I want to get rid of it, I can.
And that person is undoing the low interest rate environment because he's probably paying cash to get in quickly. And so it doesn't matter whether somebody can get a loan and can go through the process. The seller, whoever that is, if it's in a foreclosure, they're just going to take the cash right up front.
The old saying, cash is king, definitely holds true. We're coming up on a break. When we come back, we're going to give you this week's credit tip of the week. Make sure that you are not paying off your credit card in full every month because it could be hurting your credit score. Stay right there.